Going. Perfect. All right, guys, today we'll be covering capital gains tax. Of course, these are your prescribed readings. You've got your SILC, then also you've got, your SICA income tax legislation is the textbook that we use, perhaps to make sure that we understand the tax in South Africa. All right. So, guys, let's just talk about these things. You see, just to find out where are we in tax computation. Yes, so we talk about the capital gains tax. So when you go through your tax framework, you've got your gross income, you less your exemption, then you've got your income. But you've got to know very important principle. Before you can less any exemption, you've got to include that in your income. In one of your exemptions, of course, the example that you might have there is a dividend income. It will come as your income, but will also come as exemptions. Yes. Then it will also come as your exemption. And you'll have to add, then you less your deductions, then you add your capital gains tax. So what is capital gains? So as you can, it's actually self-explanatory. Actually, that is capital gains tax. So what they say in your gross income is that your gross income, it relates to everything which is cash or otherwise received or accrued to during the year of assessment. But they say specifically say not of capital nature. So if it's capital in nature, then it's not included in gross income. However, it will be taken into account as per the 8 schedule as capital gains. All right. So we use the 8 schedule, as I said to you people, then you've got CGT. When is it applicable? It all started in 1st October 2001. Before that, actually, there was no capital gains tax. It was introduced, so that date then is actually referred to as valuation date. If you've got an asset then that was perhaps acquired before that date, you've got to understand how much was the value at 1st October to get the valuation date. So then it applies then to all the assets, of course, that are sold, which are capital assets, meaning which these assets, when you bought them, you might have got your capital allowances, but not necessarily Section 11A. Then it is not a separate tax, and it's also not according to a separate act. What does that mean? It is still within Income Tax Act, but it has some schedule. So it's dealt with under the 8th schedule. So the part of the gain then is added on your taxable income, not all of it. Then it depends, are you individual or are you a company? Then if it's a company, 80% of it. If it's an individual, then 40% of it gets taxed. All right. So you've got this, this is just a kind of diagram, that shows you what happened. I'll just go through with you people so that you've got to understand. So this is how the 8 schedule looks like. So you've got your disposal or deemed disposal. So this capital gains tax is not only taken into account perhaps maybe applicable when you have actually sold the asset, but it's actually applicable also when you are deemed to have sold an asset. There are instances where you have not necessarily and actually sold an asset, but you are deemed to have sold an asset. One of the examples that I have for you now that comes to my mind is the donation. When you donate an asset, which is capital asset, it's a deemed disposal. Then in that case, then you will have proceeds. That will be your selling price. Then you will have your capital gain or capital loss. So you will have then to apply the exclusions or rollovers or attributable attribution limitations. Then you will have then the sum of capital gains and losses. You will reduce that by annual exclusion. So annual exclusion only applies to persons, which is a natural person, and it's 40,000 per year. It does not apply to the company. Then after that, you will have your capital gain or your aggregate capital loss. But as you can see here, all right, as you can see here, if you've got your aggregate capital gain, then you've got deduct previous assessed capital loss. Sometimes you've got your aggregate capital loss, then you've got to add this one, then you'll have now your net capital gain, or you have your loss. Then now you do have to talk then about inclusion rate. Then in this case, inclusion rate for individuals, we all know it's 40%, but for companies it's 80%. If it's a capital loss, it has to be carried forward. All right. So we've got this also summary here. We've got your net capital gain, then you multiply by inclusion rate. You've got assessed capital loss, then it's carried forward to the next year. So for individuals and special trust, you use 40%. For trusts and companies, which is not a special trust, you use 80%. Then you've got, then it will be taxable capital gain, then it will be included in taxable income as per section 26 capital A. So this takes us then to this here. It will actually be included in this framework here as capital gain. All right. Now, let's just talk about the CGT then. Then when you talk about CGT, so it's not a separate tax, of course, then it's got to be included, I mean, in income as taxable capital gain. That's what a schedule is saying. It was effective from 1st October. I've said that already. Then if you are a resident on a worldwide basis, if you are selling a property which is outside South Africa, it will be included because we know residents are actually taxed on a worldwide basis. If it's non-residents, we've got to talk about where is this immovable asset actually? Is it in South Africa? Is it elsewhere? Is it also the assets? Is it attributable also to permanent establishment in South Africa if that's a non-resident? So these are the facts and actually some lot of important information that should actually, I mean, be specified in a question, whether a company is a resident, whether a person is a resident, whether a company is a permanent establishment to South Africa. So then you've got to know that, you see, if it's equity shares, the ownership, who's owning this, because remember, we don't only talk about immovable property, we also talk about movable ones. We also need to know if it's a trust. Do we have a vested right in the asset or do we have a discretional right? Then if it's more than 80%, of course, of the market value of the entity, which is directly to fixed property. And also we've got to talk about the persons. Is it a connected person or is it not a connected person? We'll cover all those things here. All right, then when we talk about interest in immovable property, for example, we've got a question, perhaps an example here of Aaron. So Aaron is a non-resident. He owns 25% interest in XYZ Pty Ltd. So the balance sheet of which appears as follows as 28 February 2015. So what happens? We've got the capital of 7,000. We've got the long-term loan of 60,000. Then we've got a total of 180. Then we've got employment of capital. Then this land and buildings at market value. That's what the capital now is. Then we've got plant and machinery, which at market value, which is the market value in this case is 85,000. All right. So you've got the cost and you've got the market value. So Aaron disposes then of his shares on 1st March 2015. So determine whether he will be liable for CGT on the disposal of his shares in XYZ if the long-term loan financed the acquisition of the land and building or the plant and machinery. So for the long-term loan, so if it financed that, you can assume that the land and buildings are situated in the Republic. This now when it deals with interest in a property. So you first deal with the fact that the market values of shares, which then should be attributable to the following assets. Then you've got to say land, you attribute is 80%, then you've got also plant and machinery that you've got then attributable to land is 7.7%, then attributable to the machinery is 85%, of which the market value of these two is 265,000. Then you've got then to say only 67%, of course, of the value of the Aaron shares is attributable to immovable property. 67% attributable to immovable property because you've got a movable property, which is plant and machinery. Then Aaron shares then are therefore not regarded as interest in immovable property and will not attract CGT upon disposal. But we will talk about these things, this is interest in immovable property, what happens and what not. Let's just talk about permanent establishment. So when you go to the Act, then you want to find out what is a permanent establishment. Then permanent is actually a permanent establishment as defined in Article 5. Then we should show on income and capital of the organization of economic cooperation. So in examination, then you will be informed, then you will not have to worry about about this explanation. You will not have to say really now, you will not have to assess whether it's permanent establishment or not, but you should, once it's permanent establishment, then you've got to know the rules capital gains tax applies. So what is an asset? Then they refer to any property which may be movable, corporeal, or incorporeal. Of course, exclude the currency and other coins that are made from platinum, but also the right, of course, to the property. At some point, we spoke about fiduciary duty, sorry, fiduciary interest. We talk about fiduciary interest versus another one. So in that case, when you got the right to the property, sometimes you've got the right to use the property, not the right to own it, but the right also constitute an asset. So also the trading stock, I mean, if you've got proceed in that case, but it depends now. When it's trading stock, remember, trading stock is always taken as that your trading stock actually is deals with your section 20 and all that, yes. So trading stock, actually 2022, 21, then deals with actually section 11A. So, but unless, of course, there's a change in use in trading stock, which will be a deemed disposal in trading stock. However, if the asset then is changed to become the capital in nature. Sometimes you're just taking your assets from the stock, you are using it. But at the same time, you should know if your section J capital A applies, in that case, you've got to treat it the same as income in nature, not as capital, unless that's not the case. Then what is disposal? The paragraph then defines disposal, of course, and also a deemed disposal, which would be your paragraph 11. In any event, of course, or maybe an act, which you see, of which allow transfer or extension of an asset, which is, of course, might be the sale or the donation or expropriation or a grant or even cession. Sometimes the exchange of any other alienation of assets. And forfeiture, sometimes when you terminate something, when you cancel, when you surrender, sometimes when you waive, when you renounce a right, you are giving it out. Says now, for example, you are owed an amount by a person, you become so generous, then you say, no, look, man, don't pay me my money. That's a waiver of a right, so to receive an amount. So the scrapping or the vesting of an interest, the distribution of an asset by a company, the granting, renewal, extension, or exercise of an option, or even the decrease in a value of person's interest, that can be defined as disposal or deemed disposal. So what is actually excluded then from a disposal? Any transfer to a creditor of an asset, I mean, as a security. Remember, if it's a security, it means it's not a disposal, it's a security, or any issue of cancellation of share member interest, or maybe issue of participatory interest also. That's not a disposal. An issue of any bond or debenture, that's your paragraph D, is not a disposal. A distribution of an asset of a trust to a beneficiary. Remember, if there is a vested interest, then that's not a disposal. To correct an error in registration of deeds, for example, that's not a disposal. Or lending of a security by a lender also is also not a disposal. So don't confuse disposal with these ones. These actually are not disposal. These are excluded from the disposal. So also the vesting, then a member of a trustee, or a sequestration, then a member of a spouse of a person. You see, yes, where the asset is subsequently then released by the master. Remember, if there is a trust, of course, there'll be a master of high court that deals with that trust, that actually manages perhaps also the trust and all that perhaps, because the trust needs to be registered under the master. You see, yes. So the session also, or a reserve right to acquire a marketable security for a consideration which consists of or includes another right to acquire a marketable security that's not a disposal. What's deemed disposal? Section 9 is very clear. Your 9, 2, and 3, where a person ceases to pay a residence immediately. When you cease to pay a residence, you are deemed to have disposed your assets. For example, let's say now this country, I'm leaving this country, load shedding in this country, a whole lot of stores in this country. Look what I'm doing now. I'm just leaving this country. It's okay, it's fine, but that will be a deemed disposal as per this section. So that person is deemed to have disposed of then all his assets in South Africa, all immovable assets. Yes, and also then Section 8, capital A, equity shares granted to a person also that are less than 5 years before the date also, where you cease to be the residence. Also, 8 capital C, which should be your equity instrument, which also have not yet vested as well. Also, any right to acquire a marketable security will also deemed to have been disposed. Also, then you will be treated then as having disposed your assets. That's what we are saying. That's what this section is saying actually, at market value. Then and to have immediately acquired the assets, that market value expenditure must be treated as an amount of expenditure actually incurred and paid for the purpose of paragraph 20. So paragraph 20 actually outlines the expenditures that should be included in each and every asset. In a base cost, perhaps you should also include your actual costs and also your preparatory cost in case you've got to take into account of the foundation and all that. So your deemed disposal also paragraph 12 then B actually state that an asset then, if a person, there is an asset of a person who's not a resident, which asset become an asset done by the acquisition. Sometimes it's just because of the permanent establishment, but not by the acquisition. Also, when you cease then to be an asset of a permanent establishment in South Africa. Also, you see then state that if an asset then is held otherwise than a trading stock when becoming a trading stock. So as I said to you, the asset that was not a trading stock, say for example, I'm taking an asset, capital asset, but I'm making it a trading stock. It's a deemed disposal. And also sometimes when the trading stock asset is becoming a capital asset, that's also a deemed disposal. An asset also which ceases to be held by a person as a personal use asset. Sometimes there are assets which are regarded as personal use assets, but when you deem now to have ceased, I mean, holding as a personal use asset, that's a deemed disposal. Also, the assets sometimes that were not personal assets, but now are actually becoming personal assets. Also, where then assets also held as trading stock, cease to be held as trading stock by way of disposal. But of course, we've got to know an amount that should be included then in terms of Section 22, and to have immediately acquired those assets for a cost equal to that amount when you talk about this. So in this case, you'll have the proceeds, then you've got assumption that those assets have been immediately acquired at that cost. Also, if a person then becomes a resident, then they must be treated as having disposed of each of their assets, other than the assets already in CGT, of course, as having acquired those assets at a cost. Because remember now, you are becoming a resident. So these assets still belongs to you. So you are deemed to have sold the assets, but also reacquire these assets also at the cost. But remember, at the cost equal to the market value of each asset. Deemed to have sold them at market value, but also deemed to have reacquired them immediately. Then what happens to the debt waiver? What happens if you owe me money and I am saying, no, look, Manel, I'm keeping a blind eye to this debt. Don't pay me the money. So this is sometimes then, referred to as concession or compromise of debt. So this is a cancellation or a waiver of debt. So sometimes then, if by a redemption by the debtor or connected person in relation to a debtor, or sometimes there's a merger on acquisition of the claim by a debtor other than by a reason. So sometimes it's just a conversion into exchange of shares in a company to say it's fine, the debt is waived, you will give me shares. Sometimes a settlement out of the proceeds of share issues. So paragraph 12, capital A then deals with these concessions. Then the amount, of course, which is cancelled will be the debt benefit to the person. But the amount that by which the face value, the of that value exceeds amount incurred in redemption of the acquisition of the debt claim, then if the creditor then was not as a shareholder and the debt in exchange of a share issue out of the proceeds of share issued, the amount then of that face value of the debt claim then exceeds the market value of the share acquired. And also if the creditor was a shareholder and the debt is exchange of a share issue or out of the proceeds of shares issued, and the amount by which the calculate of market value of the shares held and the face value of the debt claim.
Oh, 5,000 ungarenti ungathini ngingazaza because wayezikhayela nkosikazi futhi yesasawele kunyanga kufuna kwenze kuzo hayi bo imali uzowenza hlobo luningi
Hello
le
guys, mute
internship
yourselves please.
ngoba phela
Unless
Hello.
you've got something to say. Ntobeko, please mute yourself. Thank you. All right, let's get on. All right, we've got an example here of a debt waiver. So a concession or a compromise of a debt. So we've got an example here of PTY Ltd, which is a private company, has 10,000 issued shares, which are valued at 1.950-ish. Of which the value, of course, of the whole entity is 19,500,000. So then we've got A, who is not a shareholder, is owed 10,000 by B. Then A agrees to accept settlement of debt by way of B, issuing 5,000 ordinary shares to A. Now you see in this case, we've got A, we've got B. They agree to settle a debt in this regard. So you've got the market value then of 15,000 shares of B. Of course, after implementing then 20, we should actually be 9,500,000 or maybe 190. I think per share actually is actually 1,166 per share. So in that case, if you say 1,166 per share, then let's just do some calculations here. 1966.66 times 15,000. We're getting 29, yes, 29,500 actually. So the face value then of the claim before implementation is 10 million. Then the market value of 5,000 shares issues, because remember, there are new shares that are issued now. So we've got 983. Actually 9,883,383. Then you'll have the debt benefit. But you always look at the debt benefit. How much is a debt benefit in case there is a waiver? Because remember, in this case, someone is paying, actually an amount is actually owed only 10 million. However, now there's a market value of shares, the shares that are issued in 9,883. So there is a benefit in this case, which is 166,667. Number two, we've got B, that has issued 10,000 issued shares, which are valued at 1.9 CS. All right, in total, then yes. So then we've got A in this case, a shareholder holding 2,000 shares is owed. Now we've got a shareholder in this case is owed 10 million by B Pty Ltd, the company. But A is a shareholder. He agrees to accept a settlement of debt by way of B issuing 5,000 ordinary shares. So if in that case, you've got a face value of claim before, which is 10 million, then the market value of 2,000 shares, we've got to calculate that. Then you find 3.9 now, value of total investment before implementation, then will be 13.5, then market value of 15,000 shares. Because remember, the 15,000 shares now will be 10,000 shares actually, and also the 5,000 shares after implementation will be 29,500. Of which in that case, of course, per share is 1,116. Then the value of 7,000 shares held by A is 13,766. Then there's also a debt benefit of 133,000 in that case, because of this arrangement of this debt waiver. So the paragraph 12 capital A then actually deals with the application. For example, applies where a debt benefit arise in a year of assessment by reason of a concession or a compromise, and the amount of debt was used to finance expenditure other than expenditure to acquire trading stock. So sometimes if the debt was used to acquire trading stock, it's treated differently. But in this case, when it was not used to acquire trading stock, then in respect of which a deduction or allowance was granted. So we've got an asset where there was an allowance. So then in this case, then we'll have to proceed on the basis that the most recent amendments, of course, there were some poor amendments before. So paragraph 12A then will apply in respect of any debt then arising on that benefit if it's not a trading stock. So your paragraph 12, capital A3 applies where expenditure was used to fund an asset that was not disposed of in an earlier year of assessment than the year in which the debt benefit arise. Because remember, the asset might have been disposed, but in this case, remember, sometimes you owe the bank, let's say you owe the bank 2 million. Now you owe the bank 2 million, you took the money and actually purchased an asset, asset. 3 years down the line, you sold the asset. Then after that, you've already sold the asset, there is a debt benefit. The amount then of the debt benefit must be applied to reduce the amount of expenditure actually incurred in respect of an asset as compared in paragraph 20. What does your paragraph 20 mean? Your paragraph 20 talk about the base cost. So it means then if there is a debt benefit and the asset is still within the person, so what will happen that if there is a debt benefit, let's say, for example, I took 2 million to buy an asset. Now I bought an asset of 2 million, but at that point in time, when I'm getting the debt benefit, I only owe 1 million. So it will mean the base cost of my asset will be reduced by the debt benefit. That is what this section means. Because remember now, it means when you're calculating your capital gains tax, then in that case, there will be a difference because there is this reduction in base cost. Your paragraph 4 then applies where expenditure was used to fund an asset that was disposed in an earlier year of assessment than the year which the debt benefit arise. Say, for example, now, the asset that I went on to buy using this 2 million, it has already been disposed. Now, all of a sudden, come year end, there is a debt benefit. The debt is waived. The gain then of the loss on disposal must be determined in that case, and the debt benefit had been taken into account at the time of disposal. We go back, we kind of say, what if the benefit had been taken into account at the time of disposal? What could have happened? We redetermined everything. If the gain, then any difference then between the gain or loss before that and the new determination then will have to be taken into account. You see, it will be shown as capital gain, you see, that have arisen before when the benefit actually arise. This is an example where I'm saying to you, I went on to take 2 million. However, after I've taken this 2 million, I went on to sell the asset. I've sold the asset, but now later on, I'm getting a debt benefit. We have got to redetermine everything. That's your 4. Para 6, then which is exclusion. So if maybe it's a waiver by deceased state where the debtor is an heir, or maybe is a legatee, then the debt forms part of the equitable estate, so it's excluded. Also, the reduction then of the debt by donations or deemed donations in respect of Section 58, which is subject to donations tax, it will also be reduced. So where also there is a debt reduction as a taxable fringe benefit also under paragraph 2H of the 7th schedule. Also, we've got some exclusions also where a debtor and the creditor are part of the same group. So this section then is excluded, paragraph 12, capital A, and also where the debtor has not carried on a trade in a assessment in which the debt benefit arise and immediately preceding that year also, and unless of course the debt was used to fund an asset that was subsequently disposed of. Of course, in case of the transaction of Section 42 or 43 or 47 applies, or maybe the debt was incurred to settle or a takeover or refinance or a renew of any debt incurred by a group company. So those will be excluded. Your 6E also, your 12 capital A 6E, Then where a debt is reduced in a course of liquidation, or the company is being wound up, or is deregistered, or termination of a debtor. So in that case, that will also be excluded. And also if a debtor company has not taken steps, you see, it's contemplated, of course, section 1 to liquidate or deregister within 36 months from the date of a debt benefit, then or maybe that has been withdrawn or invalidated of such steps. Your F, then where the debtor is a company and almost owe the debt to a company that forms part of the same group, and the debt is settled directly or by means of issuing of shares. Of course, except where the debt was assumed to settle or refinance, or maybe a takeover or a renew of a debt in that company. So this does not then form part of the same group or companies at the time of the debt is settled, but you've got to take into account that. Your G, also where the debt is settled by way of an issue of a share or out of proceeds of an issue of shares to the extent that the debt was settled does not include any amount of interest. So you've got to determine, is there any amount of interest? Then we go then to the time of disposal. Then as per the guide, then it's very important principle that if in case there is an agreement, we need to know the time of disposal. There is a time that agreement becomes unconditional. If they are still conditional, then that cannot be deemed as time of disposal. Then in the case of loss or destruction, when of course there's full compensation that needs to be received, or if no compensation, then when the establishment, then that no compensation is payable. So that will be the time of disposal. Sometimes there may be special rules which apply to residents and also to ceasing to be a resident. As we know, ceasing to be the resident is immediate. When you cease to be the resident, then that's a time of disposal, actually deemed disposal. Then what is the base cost? These are basics. Your para 2 end of age schedule deals with base cost. So expenditure actually that is actually incurred in respect of the cost of acquiring the asset, and also some expenditure that for valuation of an asset and sometimes determining the capital gain or loss. But also you should know your para 20 also specify, for example, if there is a need for, in case there's a need for there's a need for foundation, in case there's a need for transport, is taken into account your para 20. Base cost also, I mean, the following amounts also that can be actually incurred or directly, sometimes transfer. I just said to you guys, sometimes you see all those things, stamp duty, but all the costs actually as per the account that are incurred to make sure that the asset is actually brought to a state where it's deemed necessary by management. Yes, you've got to know that. But also, if there's donations tax, you need to know what happened in that case. You cannot be taxed twice. So in case there was donations tax in an asset, then there are also some implication in that case, because donations tax then will actually, in case when you dispose an asset, it will actually increase or your base cost. So we've got the expenditure actually incurred for purpose of establishing, for example, maintaining or maybe defending a legal title. Also, the expenditure actually incurred in effecting improvement or to enhancement the value of an asset. Then you got also your G, where 1/3 of an interest as for 24J, which excluding interest then, also maybe money borrowed, expenditure in respect of shares also is recognized as an exchange. In that case, will also be taken into account. Sometimes refinance the borrowings. Base cost also in terms of age, then marketable security or maybe equity instrument, then as per section capital A or C will be the market value and amount received or accrued, I mean, from the disposal that was taken into account, determining the gain or loss or subject to pay. Your A then, in case of any other assets, then an amount then included in respect of section 8.5 applied towards the reduction of a purchase price, or perhaps maybe your BEP, an amount included in gross income in respect of paragraph I of the gross income, also the 7 schedule, also the amount, also any amount included in gross income as per paragraph H of gross income in terms of the definition. and also in amount included in gross income in terms of your paragraph C of gross income definitions. So in case then if it's a common, then it will be in case of CFC, then it will be anything which is actually held by residents, which will be the amount which is net of income imputed in income of residents. In respect of section 9, capital D, during any of assessment, we've got to less than in that case foreign dividend distribution, then all those things. And also remember your section 10, capital B, but you don't have to worry about your number 4 then. Then also number 5, if assets was acquired by residents by way of inheritance from non-residents, then you see at the same time that the market value then of the asset immediately before the date of that deceased person, and also an expenditure that was incurred by the executor of a deceased person in respect of that asset. Because remember, the executor may incur some assets as well when the person dies. Those may include some additions, perhaps maybe if there's a need for additions in an asset. Perhaps maybe there are some renovations by executor, then all those assets will have to be taken into account as per para A. So in case then of an asset which was acquired or after the valuation date by a person or by that time, remember the valuation date. When is the valuation date? We need to know that's 1st of October. So if there's an asset that was acquired before that, and you find out that that asset, there were some additional, for example, additional costs that were incurred, the improvements, all those has to be taken into account. Then your para 20 then deals with the expenditure incurred by a person also in respect of an asset, which does not include any, which may not be borrowing costs, which may not including any interest, for example, because you've got your section 24J there, and also expenditure on repairs or maintenance. Remember your repairs and maintenance, we've got to know exactly which repairs and maintenance actually is, yes, but that's not included then in your base cost. And also the valuation date, you see, in respect of any right that was acquired of marketable security, as per section 18, capital A. Also other borrowing costs, expenditures will not be included. Because remember, these other repairs and maintenance, sometimes they will meet a definition as for the special exclusions. So the special deductions, if not form part of a base cost. Then your base cost then will have to be reduced then by an expenditure, which is reduced, which is an allowance, of course, for the tax income before taking into account capital gains tax. And also if there is any, by any reasons, which is an amount that has been paid by any person to extend that is not taken into account as a recoupment, is not as the recoupment, then also as for paragraph J also is not included, then it will also reduce the base cost. Also, if there is an exemption from a tax and which is granted paid for a purpose of acquisition of an asset, also that will also be reduced the base cost. And also if there is any government grant or scrapping payment, that will also reduce the base cost of an asset. Also, you've got to know then base cost and Forex. This is important because remember, last week we did Forex. So if there's an expenditure incurred in respect of acquisition of an asset, then shall be reduced by an amount of a Forex gain or premium as per section 21I, we dealt with that last week. Or then if there's an increase by an amount of any Forex or loss premium then paid, which is section 24. Then if that gain then a loss is not included or deducted from an income of that person, this is very important. If it's not included or deducted, then it will then result to the reduction of the base cost. Okay, we've got this table here. So we've got an asset, we've got the valuation basis. So if you've got listed financial instrument, then you will use your last quoted price on the last business day before the transaction date. If you've got your long-term insurance policy, you will use the greater of surrender value or fair market value, the greater of the two. You should know one thing when it comes to SARS, and there's some that is to be included, perhaps in taxation, they always use the higher of the two. But when it actually comes to the deduction or allowance, they use the lower of the two. So if it's a fiduciary interest or usufruct or similar in nature, then the value, of course, which will be used. But you should know, you should not worry yourself about these 12%, these limited interest. You should be given the value of the usufruct. You will not be expected to do the whole calculations, the whole complicated calculations in this regard. If you've got an asset which is subject for fiduciary duty or usufruct, then in that case, you lose the market value property less the fiduciary interest. This happens because you've got one asset per se, but this asset, there are different rights in this asset. So someone else has the right of use, someone else has the right of, you say, ownership. Then that's where it happens. But you should know then the annual value, which is in the 12%, you don't need to worry yourself about this. As I said to you people, you don't have to relation this table that you have got to use, because you use the life expectancy, as they are saying here. You use the life expectancy using the tables. You don't have to worry about that. In case you've got your bare dominion right over the property, then you use the market value less the value of fiduciary. Because remember, the bare dominion is the right of it's actually the right of ownership, then the right of use is fiduciary. So you've got to deduct and see the value of the right. In case you've got immovable property or for farming activities, you always have to reduce it by 30%. For any other asset, then use the price that will be used to obtain by the willing buyer, willing seller, which is in that case the market value. All right, the base cost of identical assets, what happened? Para 22, they say sometimes it's difficult to identify. If it's similar in nature, they've got the same amount of money. You've got the same amount of proceeds will be received irrespective of which of the asset then in this case is specified in group. So if you cannot individually, distinguish an asset, you may elect to use the FIFO method in that case. So the base cost also, you may use the weighted average. You may elect, if you elect to use this one, for example, for local and foreign shares, maybe for participator shares as well, also for gold or platinum coins. So these are just examples of these identical assets. So if you determine then the weighted average, then you'll have to add all the cost, then you divide, of course, by the instrument. Once the method has been chosen, then in the specific group, you've got to look at that method. Then you use that method in that group. It's in that specific group when it's been disposed, perhaps until such time it's disposed. So you cannot change now all of a sudden, want to use FIFO. So you've got to allocate then the cost to part of the base cost. In this case, or we should have the market value of the disposal, then we should be determined, of course, before the disposal. So the balance then of the cost, we should be taken into account, and the rest of us are then disposed. In this case, actually, you are using that the weighted average, but for your sake, we will not go this far, really wanting you to apply this weighted average. No, that will not happen. But in case you've got a leasehold improvement, if it's disposed at the end of the yield list, you need to know that whether there's a replacement of the asset part when another asset is repaired. You just need to know the base cost of that. We've got an example here, guys, of Mr. Jones. He owns 2 hectares piece of land for a number of years. Wow. That's quite an amount of land. So there is a developer that's offering him all 400,000 for 1 hectare of land. So the market value of the entire property is 1 million. The property has been acquired 2014 for 700,000. So you acquired the property 700,000. The whole value now is 1 million. It's offered for 1 hectare, 100,000. So in this case, you will have proceeds of cost of 100,000, then the base cost, we know, but now the base cost, you'll have to take them into account now based on what? Based on them on the offer. Because I think now in this case, you take the offer, which is deemed to be market value, then you divide it by what? By market value. As you can see, that's why we've got 400,000 divided by 1 million, which is the market value, multiplied by 7,000. Because we want to determine the base cost actually relating to this 1 hectare. Then in this case, then we'll have what? We'll have an amount which is 280. Then, as you can see, we've got a capital gain then of 120. Another example of Mr. Jones, he owns now this case, as you can see, the property, 2 hectares as well. Then he purchased these 3 separate pieces. Part A for 300,000, Part B for 250, and Part C for 150. Then he consolidated them. He has 1 title. A developer now is offering him 400,000 for 1 hectare, which comprises of Part B and C. The market value of the entire property is 1 million. So the property then was acquired. Then, as you can see in this case, we got profits of 400,000. The entire cost is 700,000, but we've got the base cost now of 1 hectare. So in that case, we'll have 250 plus 150, which is 400,000. Then the capital case, then in that case, will be nil. Because in this case, we are specific how much is actually given and how much is actually the base cost. So the base cost, as you can see, land number 1 was 250, land number 2 was Part A was 300, Part B 250, then Part C was 150. Then what happens to capital gains of non-residents? That's a section 9J. So which is held as register. So it's deemed to be movable property in South Africa, and also deems an interest in movable property in South Africa to be from a South African source. Because remember, this person is non-residents, everything that they sell then is deemed to be they're actually taxed on a source basis. So the same principle then applies when it comes to CGT. So if there's an interest to a right to a movable property, this may be a right for variable fixed payment of consideration. It may be a right of any entity, shares, equity ownership. It may be a vested right, say in a trust. Then if that's the case, attributable to movable property situated in South Africa, then also if at least 20% also direct or indirect held, also that will also lead to what? To capital gains tax. So also a paragraph in the time of disposal, which is the date when the contract is concluded, or maybe the time of vesting in case we've got a trust. Because remember, you can have a beneficiary of a trust that is not a resident. So the time of vesting then, that will be the time of disposal. Or maybe when the legal requirements are actually met in case it's a donation, for the time when the compensation is actually given, if it's expropriation. Maybe the discretion, also the date in which compensation actually takes place. We need to be very specific about that. Also, if you are married, then in cooperative property, then you see also we need to know the time of disposal in that case, and also if it's a joint estate, because if it's joint estate it means you need to know, is it a joint estate with accruals, with no accruals, anti-nuptial contract, post-nuptial, all those things needs to be outlined correctly. What are proceeds? This is just an amount received as a result of disposals. So any amount then is proceeds. But amounts that are excluded then will be the VAT portion. But of course, that is if you are a reserved vendor and also there's another entity. Of course, then also if there's another that needs to be repaid back, then if there's also any reduction to proceed due to contract reconciliation or waiver, then that's excluded. What if you've got unquantifiable proceeds? So the actual says you defer the accrual of proceeds until the amount then is quantifiable. because you can't determine it now. It's fine until later on. So if, for example, acquisition of unquantifiable amount, it's also deferred the expenditure until the amount is quantifiable. I mean, really, how much are you going to be deducting? How much are you going to be getting an allowance on? Because you don't know the amount actually is not yet determined. So sometimes also if it does not determine nature of amounts, the capital loss also can be ring-fenced until the amount is what is quantifiable. Ring fences of losses also. If you've got unapproved proceeds, sometimes you can also have capital loss, which is ring-fenced, which will have to be disregarded. But of course, you'll have to justify why do you feel like there is no evidence, you see, yes, of further proceeds coming in. What happens then to connected persons? These may be children. They actually explain in this slide the extent in which connection is regarded. Is it a first degree, second degree, third degree, and all that? You see, so you've got just this page just giving you an overview of the degrees of connectedness. So your paragraph 8 then linking with paragraph 8.4, then you see you have your deemed recoupment. Remember, what happens to the recoupment is if now all of a sudden you are allowed a deduction, you've been enjoying deduction all along, all of a sudden you are changing your mind, you are selling an asset, then there should be the recoupment in that case. If the asset then acquired and also disposed in a foreign currency, you need to know what to take into account, what's a foreign currency definition, it's all defined, and also the fractional currency. You've got to know and calculate, I mean, in case of that, and also use the translation rate, which is the spot rate at that time, at that date in time. Then you've got paragraph 43, which applies to a disposal of an asset. If it's a company, it's a trust, or an individual, which is not trading, a trust, maybe you buy and sell an asset in different foreign currency. Then your paragraph 12 then, if the asset is for a non-residence, which is with a permanent establishment in South Africa, then also if it's non-trading stock, that becomes trading stock. Remember, trading stock becomes non-trading stock. What does it mean? Non-trading stock becomes trading stock. There is always a deemed disposal. Sometimes an asset ceasing to be personal use asset. That has been outlined before. An asset commences to be a personal use asset. Because remember, personal use assets are actually disregarded. So these are the events now that will be deemed disposals. Sometimes a donation, consideration which is not measurable in money, sometimes a disposal to connected persons, sometimes during the debt. Those are all your, as you can see also, connected persons during debt, section 9 capital A will also apply in that case, which will mean that there will be no capital gain perhaps relating to your spouse. So the market value then needs to be determined. Then you can elect a pre-valuation date, but this will apply, of course, for the 3 transactions. But remember, once you talk about the pre-valuation date, it means if the asset was acquired then before the actual of this act coming into effect, which was 1st October 2001. So then the proceed then will have to be determined in the same currency, expenditure, everything. So you convert everything to same currency. You convert everything, then you, of course, will have your differences here and there. You may recognize them here and there, but if those differences will not be added as gross income in any party, then they will reduce what? The gross. They will actually add the base cost if they will not be added. But if they'll be added as income, they will not. Primary residence exclusions, then we all know primary residence, just go back, guys. Just check your blind spot a little bit before your capital gains tax for 3rd year, all those primary residence exclusions, if you are living in a residence. So you'll have your capital permanent personal assets, personal use assets, they will all be excluded, cryptocurrency, suspects trade also in respect of section 20 capital A, also they'll be excluded, also your retirement benefits, all those things. Just go through actually these paragraphs, just get to understand them in your act. Actually, guys, I believe all of you now have the act. You've got your income tax act. You cannot be at this level really without that income tax act, because you are likely to struggle. Because when you refer to these paragraphs, we refer to the paragraphs in an act, but then within the act, it's each schedule in the act. So we've got closed rules, then some losses, of course, or disposal to connected persons will be disallowed. If it's not permanently, maybe closed until such time happens. Sometimes there's a further sale for a connected person, then you can unclock that. So if you've got a loss, you kind of clock it. Then if there's a sale, actually, you see, then the loss, you clock it. Then if there's a profit to that connected as well, then you can you see set off each other. Sometimes then the disregardless of loss may be set off against capital gain from further disposal for the same connected persons. So they are saying because it was a connected person, you had this gain, then the loss also will relate to that. Then your paragraph 64B, disposal of equity shares to foreign companies. You have the attribution of capital gains. That's your 60, 70, 30, which is also covered in trust lecture. We'll be doing trust soon. It should also be covered when you deal about the trusts and the trust beneficiaries. Yes, and also the company distribution. Also, when you deal with dividends in special dividend lecture, it should also be covered there. Your capital gains also deferring of tax liability, your paragraph 66, which is voluntary disposals, then you can actually defer the liability in that case. And also you can defer liabilities of capital gains when it deals with would also be dealt with when you deal with the person now, the dead person, when you deal with estate planning, how to defer it, and also when you deal with the executor, I mean the deceased estate, it can actually be deferred. Your section 9J also assets. Also, you'll have to link all your section 8.4. You see all your 8.4, those that relate to actually to your equipment. Also, but you also might have also to look at your paragraph 65, which is the involuntary disposal. So these involuntary disposals sometimes happen because something it's just happened. Sometimes we make an example of there was just perhaps maybe there was just a fire, then it was a fire in a place, now it's deemed disposal. But what happens in that case was you are getting sometimes you are getting an insurance for that, then that's a deemed disposal, but it's involuntary disposal, meaning it's not voluntary in nature. So you deal then with paragraph 34 of HH. You will also which will link your paragraph 35 of the debt execution, or maybe a reduction, or maybe discharge of a debt by disposing an asset to the creditor. Sometimes you are disposing the asset to the creditor. You are giving them you are giving them the asset. If you are giving the asset then to the creditor, but you owe this person, remember, but now you are just giving them the access. So even in that case, then there is a link there. You'll have to talk about that. All right, guys. Thanks very much. Then I think just for the announcements, I've just checked for you guys here. You are writing your second test. You are writing your second test on the 7th of June. 7th of June, you are writing your second test. See, which is actually not next week, Friday. That Friday, you'll be writing your second test. So guys, you should know this is the last class which should be included in your test, meaning which whatever we'll be doing next week will not be included in your test. For those that join late, you've got the tutor now, Mr. Jacobe. He is the one that will be assisting you in tutorials. So what will happen then? The tutor will the class rep actually. I will give him the contact person, the contact number of the class rep. He will contact the class rep, and then there will be arrangements. You will make arrangements of how you people go on about this, how you will have your chat with him, the time and all that. I'm open with that. You will deal that with him, which time actually is perfect for you guys. But as I said before, then I'll share the question with him. Then he kind of go through the question with you in class. If you've got any question, then he try to assist you going forward. But these are all mechanisms, perhaps, or interventions by the school to make sure that you people, you really try your best to pass this course this year. And as I said to you, you're kind of lucky this year that you were able to get the tutor. Last year, we were not able to get the tutor at all. All right, yes. So guys, I'll give it to you. Do you have any questions for me or something?
Sorry, Masipulele, can I please confirm something with regards to test 2? So the scope for test 2 is everything that we've done thus far.
Yes, including this lecture. But excluding
Okay,
next week's lecture.
thank you.
Because remember the test
Okay, thank you.
All right.
Sorry, is it including the topics that we cover for test 1?
Yes, remember, we may just say that we may just say perhaps